But understand, this is the way that institutions commit large money to the market.
Mm,
They use program trades based around the VWAP and the anchored VWAP. That's direct out of congressional testimony from Ken Griffin, saying that when they were talking about the GameStop, saying this is how we execute orders. That guy made $4.1 billion in 2022, more than any hedge fund manager has ever made in the history of hedge funds in 1 year. I think
wow.
when he says something like that, it's worth listening to.
This episode of the Speculators podcast is sponsored by Elite Trader Funding. Elite Trader Funding is an evaluation company that provides traders with the opportunity to earn income by trading in a simulated environment and never having to risk their own capital. All you have to do is pick an evaluation and follow the rules. Traders who pass the evaluation will keep 100% of the first $12,500 in profits and then 90% of all the profits after this. You can get started today with Elite Trader Funding by clicking the link in the description and using the code ETFCORBS for 40% off every evaluation that you want to do, except for the fast track. Those are already heavily discounted by default. Now, the most important thing about Elite Trader Funding is this is a company that you can trust. They're reputable, they're trusted by me, they're trusted by thousands of other traders, and they have a 4.5-star rating on Trustpilot. They have an active Discord community, they have incredible customer service, and they have the widest selection of evaluations on the market. So whatever style of trading you're into, they're going to have the perfect fit for you. They even have a swing trading option, which nobody else offers. We're gonna say more about this later in the episode, but a big thank you to Elite Trader Funding for sponsoring this episode. I'm very happy that you're here. Let's get started with today's episode. Mr. Shannon, welcome to the channel. Thanks for stopping by.
Well, thank you. Nice to be here.
Yeah, thank you. It's Thursday at the time of this recording. How has the week been going for you?
It's been a slow week for me, really. We're kind of, bouncing around here in this market, trying to find support. So everything I've been doing has been smaller share size, but, still profitable for the week. But with small share size, it's tough to make much progress, especially when things aren't really getting the follow through in either direction right now. So I'm pleased.
Yeah, very good, very good. Okay. Well, I tell you what, maybe as just kind of jumping into the conversation here and to lay some of the foundation, could you just explain how is your approach to the market, or how would you describe your approach to the market?
Yeah, I'm a swing trader first and foremost. That is, I started out really kind of as a swing trader, and then got more into day trading, and then drifted back to swing trading. Probably more so in the last 10 years. So I started out in 1991, just to give you an idea. So I've, kind of seen all the markets that we've had in the last 30 years. And swing trading is just what makes sense to me. It's technically driven. I prefer the long side, and I go with what I call trend alignment. So what I'm looking for, we'll just use the example of long, is a stock in an uptrend, it then pulls back, and I don't buy the dips, never want to buy a dip. I wait for stabilization on a shorter term time frame, such as a 15-minute time frame, where what we typically see is maybe a 6-7 day rally, 2 to 3 days of distribution, 2, 3, 4 days of pullback, 2 to 3 days of sideways activity, then the new upward momentum begins. So I like to latch onto that momentum just as it begins on the shorter term time frame, and then it's in alignment with the longer term uptrend as well.
Yeah, very good. Okay, so you're looking for bigger moves. You're not trying to catch maybe the start of a trend. You're waiting for that pullback, letting that pullback find its equilibrium, and then as it goes for continuation on that last move, or at least the established trend, you're looking to join that and go in for the continuation.
Exactly. Yep.
And very interesting.
Risk management, of course, is cornerstone. I didn't mention that, but I need to mention that at every turn, because that's the missing piece that so many people are, the piece that's missing for so many people.
Interesting and I would agree. Thinking about just to flesh out the method here a little bit more that you're using, you are trading individual names of companies, stocks, or?
Most of the time I prefer individual stocks, but once the market starts kind of not giving the individual setups, where we're still in pullback mode, or those stocks are still trying to stabilize, I'll trade those in smaller share size, but I'll revert to some day trading in the indices. So again, It's not my preferred time frame to day trade, but I've got the skill set to do it, and got to do something while you're sitting here.
For sure. So do you have a small basket of individual names that you're kind of keeping your eye on if there's opportunities there, or are you scanning maybe like the entire market and doesn't really care about what cap size, or how's that work?
I have a couple general rules, such as it's got to trade at least 500,000 shares a day based on the 20-day average is what I use. So that's one criteria. I don't really care if it's $2 a share. I don't care if it's 200. Over 200, 300, I generally don't trade in those as much, but it's not a core basket. I mean, I look at a core basket as well, just for, market, and when we have those shorter term opportunities, it's, be foolish not to look at Apple and Tesla and Nvidia for opportunities on the short terms. But for my core trading, they tend to be probably more mid cap than anything. And I filter through a large number of stocks each day, looking for the setups that I think look like have the highest potential and the lowest risk. So I'll look at, on a weekend, I'll look at 800-900 stocks, drill those down to about a list of 200 that I look at each and every day during the following week. And then as I drill down through those 200 or so, I'll come up with a list of, 15 or so that I want to keep an eye on the next day.
Wow. Okay. Good Lord. You're really ripping through these charts. That's interesting.
I've been doing it, Corbs. I've been doing it since 1991, full time, looking at these charts. So I look at every chart I look at. I can get through that list of 200 in under an hour. But I'll look at a weekly chart. So they're all linked together on the same screen. I've got a weekly, a daily, a 65-minute, 30-minute, 10-minute, and then finally a 2-minute time frame. So I'm looking at them all on those multiple time frames, so I understand the bigger picture as well as what I think might happen in the coming 3 to 5 days, hopefully.
Yeah, very interesting. Now, with the way you're trading, every single day, is there potentially trades, or is there a lot of situations where maybe you have enough open positions that you're just kind of managing it and waiting for something the ability to take on more risk?
Ideally, I'd like to be in a position where I don't have to add things, but generally speaking, the way that my risk management is so tight that I typically hold a stock normally 2 to 4 or 5 days.
Okay.
And longer term up to about 3 weeks, and then maybe a third of them get stopped out on day one. So I would like to be able to hold stocks, and I keep telling myself I want to be a longer term holder, but the market just doesn't let me with my risk management. So it's I'm not willing to tolerate big drawdowns, and so I end up getting stopped out of a lot of things, and sometimes they continue higher, but I end up doing, for the most part, getting good exits.
No doubt. No doubt. Could you walk us through just like a normal day? Let's say from the time you wake up, if there's any kind of morning ritual type stuff that you do to get ready for the day, what a pre-market looks like for you, what happens when you're on the screens, if there's any type of like dominant focus or thought that you have, or wrapping up the day, if there's like an end of day ritual.
Yeah, and let's start there actually, because that's where my next day begins.
Okay.
It's typically at about 3 p.m. Eastern. And the reason for that is, over the years of trading, I've realized that most of the trades that I put on in the final hour are not successful. I've been a net loser in that final hour with new trades. So I'll set some alerts on stocks that might look interesting into the close, but my preparation for the next day begins at 3 p.m. That's when I pull up those 200, that list of 200 or so names, and I go through those. I then, write them down on a little sheet of paper. Oh, I guess my screen's all fuzzy. You can't see that. So I'll write them down on a little sheet of paper, and I'll look at those and get it down to, again, there's probably 15 names there for tomorrow. And then I will look at those a little bit more carefully. So I have a subscription service at AlphaTrends. As the market closes, I do a daily wrap up of the market. And then I do another brief video that is educationally driven about, here's how these stocks are set up. Here's what we're looking for. Here's how we're anticipating this trade to set up. And then the next day, I'll wake up again, looking at my tendencies and biases. I try not to get in front of the computer. If there's a big economic number, sometimes I'll get there at 6:30 a.m., which is 8:30 Eastern, so I'm in Colorado.
Okay.
But that generally gives me too much time to get into trouble. So I like to sit down at about 9 a.m. Eastern. What I might do is, wake up, get coffee, go through my emails, read, certain market letters, and I don't really read them. They're just kind of the synopsis of the news. So I have an idea of what's driving the psychology of the day. I don't really read the articles so much, but more the headlines to say, here's what people are talking about. I don't care about this reporter who's been out of college for 3 years, knows nothing about the market and his take on it. In other words, I don't want to develop a bias.
Okay.
So I don't turn TV on because that's a weakness of mine as well. If I hear something, I'll get interested. I'll pull up a chart. So then, the market opens. I'll try not to trade the first 5 to 10 minutes. It's again just not something I'm generally good at. If I have overnight positions that are gapping up significantly, I'll often sell most of my position into that gap, but I don't initiate positions prior to the open. So as my alerts start triggering, I'm looking at my focus list of that 15. There might be 3 or 4 that I have starred, that those are the ones I really want to pay attention to the most. Those are my A-list ideas. So I might get into a trade, or I might be adjusting a stop on something after about 15 minutes. I never want to put a stop in before the first 15 minutes of the day, because as I always tell people, that's how you get your stock stolen from you. So I, monitor my positions. I reset a bunch of alerts. I start new positions, manage the open ones, and then at 11 Eastern, I do a quick update of the markets for subscribers. And then the rest of the day, I'm, either involved in a project or just I'm generally don't put on many trades after about 11 Eastern. So my sweet spot is probably between 9:45 and 11 a.m. That's when the majority of my trades are put on. And then I'll, look at new ideas, maybe see what people are talking about, and just kind of repeat that whole process day after day.
Yeah, very nice. You said a couple of things there I really appreciated, and a lot of wisdom in this. You said, certain times if I get in there too early, I get myself into trouble. And
right.
I think everybody's experienced this of there's not this benefit, and you need to find this sweet spot for yourself of, if you do just kind of hang around too long when you're already prepared, there's nothing else for you to specifically do, but you're kind of in that mode to trade, and you're waiting, you can jump the gun, feel over anxious. You can just kind of get out of that flow. And that's a very important thing to dial in for yourself. And then you also talked about TV being a weakness of you. And then just this idea of realizing that there are repeatable things you do all the time. And if I start the day watching the TV, my mind goes in this thing, and I can't do that before I start trading. And a lot of good insights that maybe aren't even specific for somebody, but that idea is very powerful.
Sure. I mean, as you just might not apply to everyone. And that's the key,
Right.
is figure out what works for you. Again, I always say this to people. My time frame is swing trade. Here's my risk tolerance. I'm very intolerant of risk, especially as I get older. So I've always said there's an inverse number of trades that you take based on your age. In other words, younger traders, you shoot at anything that moves. You get a little bit more disciplined. You don't feel like you have to get involved in everything, and the number of trades slows down. And ideally, the time in your holds becomes a little bit longer too, as you have more patience to hold your winners.
Yeah, very, very, very true there. Do you have a worldview or like a paradigm of how you look at the market? Maybe as this idea that, this is like a blank canvas and I'm an artist trying to do something, or this is a giant puzzle I'm trying to solve, or is there kind of like a dominant worldview you have?
Well, I mean, sure. I often, mention, for instance, my end of the day routine is, kind of like a treasure hunt. I mean, I feel like a 8-year-old kid whose dad just buried coins on the beach and said, "Stay out of my hair, go over there and dig up those coins. If you're good, you'll get $2.47." So for me, it's always a treasure hunt. I'm thrilled. I love looking at the market and uncovering things and figuring them out and trying to anticipate the psychology of what's going on. So when I look at the fundamentals, it doesn't mean that I care so much about the fundamentals, but I view the fundamentals kind of the same as a chart. And by that, I mean, it's all about the psychology, that I'm not looking for heads and shoulders and cups and handles and, things that people look for. Instead, I'm trying to understand the psychology of what forms that head and shoulders or cup and handle, and how the longs feel, how the shorts feel. And then I look at the fundamentals. I say, hey, the company's got what appear to be great fundamentals. One, they might be lying to us, so I'm not going to take it at face value. I think that's another thing. I think you get more cynical the longer you're in this business, because you've seen so many shenanigans and just rug pulls. So I look at it though, and I say, here, the company's seems to be growing well. They're stating big revenues and earnings, and I know that there is a market for people who are looking for those ideas. So we've got 10,000 different growth funds out there, and they're all competing for the same type of merchandise. So if they have these fundamentals that seem to fit those parameters, in my mind, I'm thinking, well, here we've got a group of people who's likely to be a buyer of these stocks and support them because they feel the fundamentals are good. So I have a little bit more confidence in those names if it's backed up on the chart. So that, my worldview is, though, that each stock should be traded on its own merits. I really loathe these relative strength charts where people compare the NASDAQ with the IWM. I don't care. I'm not buying the NASDAQ with Russell 2000 shares. I'm buying it with US dollars. So I want to say, how is it, on its own merits? If the Russell 2000 is in a downtrend, great. If the NASDAQ's in an uptrend, I'm going to trade that. I'm not going to try to, do a pairs trade or something, but each trade on its own merits. And when there's more perceived risk, but I still like the setup, then it just means smaller share size.
If you were to have a blank chart, you had to trade this for the rest of your life, and you could only put one time frame on there to view things, you could only put one tool to help you make your trade decisions, and you could only trade one symbol, how would you set up that chart?
I would say it would probably be a 15-minute time frame that would allow me 20, let's say probably 20 to 25 days of data. I would put I just wrote a book about the anchored VWAP. So I hate this question because my answer isn't an anchored VWAP. Instead, it is it's the 5-day moving average. And by the 5-day moving average, I mean the intraday 5-day moving average. So on a 15-minute time frame, it means we're looking at 33 periods, or I forgot now. But so it's a 1,950-minute moving average, basically.
Okay.
So 130 15-minute periods. And I would just trade the swings based on that. There's no better representation of the intermediate term trend than the 5-day moving average.
What about the product you trade, if you can only trade one?
I suppose it would be, the SPY, I guess. I'm most familiar with that. I look at it every single day. There are good swing opportunities in there. So, and it's as liquid as you can be. So I could just keep growing bigger and trade that as much as I want without ever moving it.
Great. Now, great answers. And actually, you mentioned the idea of writing a book, and I'm going to pose you a question here. Sure. Take a guess. I'll give you a little bit of context, but I'd like you to guess, how many books do you think I've read on technical analysis, just in general? I've been trading for about 10 years in the game now, came up from retail, completely no direction, lost, fumbled my way around. How many books do you think I've read on technical analysis?
Well, I think this is probably a trick question. You're expecting me to say 30 to 50 or somewhere in there, but I think you're more clever, and it seems like you've found your way and know what you're doing. So I'm going to guess 2 or 3.
Yeah, you're over here playing 5D chess, aren't you? Up until recently.
Well, that's what the market tells you to do, right? I mean, if you're going to have any success in the market, that's the way you have to think.
Up until recently, I've probably thumbed through a bunch, but I've read one. And it was this book called Technical Analysis Using Multiple Timeframes.
Oh, come on.
I swear. And I don't want to derail the conversation, so I hope this isn't a bad use of time, but I want to tell you the story. Your book was recommended to me. The author of this book was Brian Shannon. And this was years ago. And the name meant nothing to me. I don't think I saw your face. I had no recollection of who you were. But I remember reading this book and thinking, this is good. It goes way beyond what you would expect with technical analysis. This isn't a book about head and shoulders or, this is a good book with like really deep understanding about how markets move. And it was good. And years later, this has been Matt, who books all the guests on the Speculators podcast. He said, hey, we have this guest, Brian Shannon, and he just wrote a book. He wants you to look at it. I was like, okay, fine. What's the book? Who's the guy? And he pulls up the book. And as soon as I saw it, I immediately knew what it was, because it's a very similar feel to your other book.
Right.
And it was this weird moment for me of all these dots being connected, of just like these years apart, of going from, I don't know who this guest is, to that's Brian Shannon. And I, unaware to me, has been a very big fan of yours and appreciating of your material for a long time. And recently, I've now, started and getting through my second book on technical analysis. So I'll say some things about this at the end, because I actually really appreciate this book as well. And I think everybody listening to this will do themselves a favor by getting a copy of it. So I'd like to say some things about it later. But
well, first, thank you for what you just said about I'm truly honored, and that's amazing. Why haven't you read other books? If I can just ask you a question. I know it's your questions, but
hey, this is my podcast.
Right.
When it comes to technical analysis, and I think coming from just kind of fumbling my way around through trading, it was just so many things out there. And I just kind of looked at it like everybody who talks about this stuff just has no idea what they're talking about. It was just obvious to me. And I didn't feel like there was somebody, your book was recommended to me, which is the only reason why I would have picked it up. Because I think the book called Technical Analysis Using Multiple Timeframes, I probably wouldn't have wanted to listen to it or read it, I should say. So yeah, I think it was, I've just been very skeptical, and I think I'm very picky about who, and I don't think very many people I would look up to even write books. And if they do, they're not about technical analysis or something around that line, would be the answer.
Okay.
Yeah.
Well, cool. Thank you.
Yeah, no, thank you for putting it together. And if anybody else, it was also probably one of the most expensive books I've ever purchased. Has anybody ever told you or complained about your books being expensive?
Sure. Writing a book is a lot of work, and I wasn't going to do it and not get paid, number one. But the information in these books is a career of experience. I've made every mistake in the book. That's why I know how to write about them. And I've survived and I've thrived in the markets. And I think people, look at a book and they say, well, this is a book. Books are $20. And if it's a shitty book, it should be $20. But if it comes, and I mean, the reviews are there, and a couple people have said that, and people try to rip it off online and stuff like that. I don't have a problem with that. I started my career at Lehman Brothers. One of the best things I learned there is that, when I would first start cold calling and opening accounts, they absolutely would not allow a discount on a commission. So I'd get the guy right to the end of the line. He'd say, well, what's the commission on that? I'd say, sir, the commission's this. He goes, well, I never pay full retail. I'm not gonna pay that, sir. So we don't discount. We don't discount quality. And that drove that into my head. I'm not going to discount quality. I know this is good. If you don't like it, return it. If you like it, keep it, pass it on to a friend or whatever. I haven't gotten rich off the book. I mean, there's a limited audience for it as well, which is why I priced it there. It's like a textbook in college. Those books are expensive too, but you're learning a lifelong skill, hopefully.
Yeah. And I would say the reason I even kind of brought this up, because I think if somebody just hears about the book and goes and sees it, and there probably will be deterred by the price, at least the majority of people. And I think it helps to hear somebody say that, yeah, if you're thinking a book should be $15 or $20, that's great. And I can testify to the fact of buying your first book, which I think I paid $70 or $80 for. And, you were gracious enough to give me this one. So I have this one now, but, buying these books, it is absolutely worth every penny, and they should be priced higher. And so you don't get deterred by the price, fork it over, pay the man. And these books are great. So anyway, let's continue, because I actually would love to ask you some specific questions about VWAP, and maybe even as a way to get people more interested in the tool and going towards purchasing a book. Can I ask you, you wrote a book called Anchored VWAP here. And in your opinion, if somebody's using the Anchored VWAP, is it using that one tool, would this be enough to have a completed method where you're looking at this tool, it's giving you the information you need for context, it's giving you the information you need to put together a good trade idea, to understand where your exits would be, where your entries would be, where your targets would be? Can it fit all those hats, or does it fit better into a method, or could it be a standalone tool for a method?
I honestly think it fits in with a method, which is why, I said 5-day moving average on a 15-minute time frame. It's going to add another dimension to anything you're doing, and it really tells you the truth of supply and demand from any point. And there's nothing subjective about its analysis. The subjective part comes in, where do I anchor from? But there's a lot of places that are, objective, where we set that anchor. So I use in my, if you ever see my videos, what you see in there is what you get. I use multiple time frames. I use some simple moving averages. I barely pay attention to volume, but I use multiple time frames, price, and the anchored VWAPs. So that's how I look at it. And I've looked at them all. I've looked at stochastics, MACD, Adams pitch, for you name it. I mean, I've looked at them all, and I'm not here to knock any of those. But this one tool has truly been the most powerful one that I've found. And not everyone has to use it, but if you do, give it an honest shot. I think it, will tie in well. It ties in great with volume profile. So it's an additional tool, but a very important one.
Is the anchored VWAP, is it useful in a market like Forex, where the data is very fragmented and it's not clean, you don't know how accurate it is?
That's a great question. It's very similar to Bitcoin.
Let's take a quick break from today's episode, because I need to ask you a very important question. Have you ever been trading up against the hard right edge of the screen, but you're paralyzed by fear? The fear of losing money? Of course you have. We've all been there, because losing your hard-earned money is a very scary thing. Thankfully, getting out there to trade and having to risk your own capital, this is a thing of the past. Thanks to today's video sponsor, Elite Trader Funding, you can now get out there, learn how to trade, start trading, and even make money without ever risking your own capital. Elite Trader Funding is an evaluation company that provides traders with the opportunity to earn income by trading in a simulated environment without ever risking their own money. All you have to do is pick an evaluation, follow the rules, and then you're going to earn an Elite Sim funded account. Here, you can start profiting, and you will keep the first 100% of your $12,500 in profits, and then 90% of all your profits after that. And it really doesn't matter what style of trading that you're into, Elite Trader Funding is going to have the perfect evaluation for you. Whether you prefer an end of day drawdown, a trailing drawdown, something more static, they have a fast track option. They even have an option for swing trading. This is something that nobody else offers. And above all, Elite Trader Funding is a company that you can trust. You don't have to take my word for it. They have a 4.5-star rating on Trustpilot, and they have verified paid out customers inside of their active Discord community. And they're paying out up to $500,000 each and every month to their clients. Now, Elite Trader Funding has an active Discord community, like I've already said, and they have top-notch customer service. So it really doesn't matter if you're brand new to the screens or if you're a seasoned pro, Elite Trader Funding is going to help you every step of the way. Now, thanks to them sponsoring this episode, we have a really sweet deal for everybody. You can get started today, and using the promo code ETFCorbs, you're going to get 40% off any evaluation that you'd like, except for the fast track. The fast tracks are already very affordable as they are. Now, I've also got some insider scoop that starting in early 2024, they're going to be launching out some major changes that are heavily going to impact the trading experience. So there's no better time to get started than right now. You can click the link in the description, use the promo code ETFCorbs, get yourself a 40% discount. And once again, a big shout out to ETF, Elite Trader Funding, for sponsoring this video. Now let's get back to the episode.
So I don't trade Forex, so I've seen people tell me that they use it in Forex and use it successfully, but I'm a little bit skeptical about that. But at the same time, I see it, for instance, on a Bitcoin chart. There's no one exchange that maybe does more than, I don't know what the number is, let's say 30%. And liquidity's all over the place. And if you actually take a look at a Bitcoin chart and you say, I'm going to use Bitstamp or Coinbase, and I'm going to anchor from this point, they're often going to be in different areas. Sure. So how do you reconcile that? That's tough. What I do is, and what I suggest is, whatever your source of liquidity is. So for instance, I trade crypto on Gemini. I look at Gemini charts because that's where my liquidity is. So that's the liquidity pool I'm interested in. And if I can find value with an anchored VWAP on those charts, then I will use that as an assist to my decision-making process.
Yep, interesting. Okay. When you're thinking about anchored VWAP, what is your thoughts about using it when we are in balance? In your opinion, should it be primarily used to follow trends, or can we, use the deviations from it and actually do fading opportunities with the tool?
Well, I'm a trend trader, so I don't necessarily want to fade the trend. What I look for though is, so for instance, going back to what we were talking about in a swing trade, that maybe we're up 6 days, we distribute 2 to 3 days, we pull back 3 to 4 days, we go sideways again 2 to 3 days. What I'll do is I'll set an anchor to the most recent peak. And what that tells me is from that most recent highest high, what is the psychology of the average long participant, or stock prices or prices below that VWAP, and maybe it's starting to flatten out. If it's starting to flatten out, then it tells me the average participant is now feeling basically kind of neutral. What about the average short seller? Well, from that peak, the short sellers were in control, but if they were averaging in on the way down, the average price since then, they're starting to feel like, well, we're at break even here. Maybe we're going to need to cover. So it tells us in that balance period, it kind of confirms that we are in balance. If I, really want to scalp that stock for whatever reason, then you could do that on a 1 minute time frame. That's not my objective. So it tells me, again, with 100% certainty from that highest, most recent high, who's in control, buyers or sellers. And if we start crossing back and forth above and below it, tells me now, well, the primary trend on the daily time frame is higher. Now we've turned neutral after a pullback. The trend once established is more likely to continue than reverse. So it's highly likely this stock will continue to move higher. Now I want to find the high point of that equilibrium over the last 3 days, make sure it's not extended when it gets there. And I'll buy that very first little poke above it and set my stop underneath the most recent relevant higher low and ride that trend up. Once it goes up to the prior high from now 9 days ago and it so-called breaks out, I always sell some there into the breakout because, you hear it all the time. People say, well, breakouts don't work. It's because you're buying a stock that's up 7-8% in the last 3 days when the proper buy place was as the buyers regain control down lower. And people don't want to buy down there because there's not much volume. They'll say, I'm waiting for volume. And it's lonely buying there, but only price pays, not volume. So as long as you have your risk in place and you are disciplined enough to adhere to it, that's the ideal place to buy, that first little higher high, because now we have the emergence of a new shorter term trend.
When you are thinking of the anchored VWAP tool, is the most important thing for somebody to understand and get right is making sure they're anchoring it intelligently, or everything else falls apart from there? Or is it more important to understand like the slope or the deviations away from it? Or what would you say is the most important part of
getting the anchor point correct? And there's some, there's a lot of objective places to measure from. So a week and a half ago, we had the Federal Reserve. As soon as the Federal Reserve comes out, I'll start on a 1 minute chart and I'll set an anchor on the SPY right then and there. And then, now here we are 7-8 days later. Now I've got that on a 15-minute time frame. And the NASDAQ is fighting with that today. The S&P is still just below it. But that tells me from that Federal Reserve announcement, which had big impact on the market, it changed the consensus view of the market because we sold off hard and we continue to sell off. Now, as we're at that kind of that equilibrium point, as you were just saying, we're kind of there. So now we're becoming neutral and perhaps the buyers can step up and take control. We're not quite there yet. Maybe tomorrow, probably Monday will give us really the best answer for that. Earnings reports, anything that causes a big shift to supply and demand that changes the consensus. Those are your best anchor points, and recent highs and highs and lows. Doesn't have to be recent. So right now the S&P 500 is dancing on the anchored VWAP from the March low of this year, and it's trying to find stability there.
Can I ask, when you're anchoring to a large news event, and this is something I actually wanted to ask you about later, but you just brought it up, and FOMC being a great example, happened last Wednesday, and you just made the comment that you're still monitoring that. When would be the point where you stop anchoring it to that event? When it moves a certain amount away, or when a new event happens, or?
Yeah, great question, and that's a tricky one for a lot of people. And and people will say, well, how do I know that that's the low? So, for instance, yesterday we had a decent low, and we've seen a pretty sharp move from that. So I've tentatively set a new anchor to that low. Now, if tomorrow we cut through it and we just continue to drop, then I'll probably delete that off there and say, you know what, it wasn't really important. For the Fed, though, it's generally no more than about 2 weeks. Does it really continue to matter? But if you look at the COVID low, the COVID low was relevant for two plus years. Earnings reports are generally good for anywhere from 2 to 3 quarters. From an IPO, I've seen them relevant, 5 to 6 years later. Oddly enough, it's kind of crazy. But IPOs are another one, because that's, everyone has the same starting place in an IPO.
Okay. Quick question for you. This is a little bit off topic, but just curious. How long does it take you to write a book like this? Obviously, a discount,
way too long,
including the the years, the lifetime of experience you need to know to write a book like this. But from the time you decide you want to write a book about anchor VWAP to the time of physical copies in somebody's hand, how long does that take?
Way too long. It was 4.5 years for that one. So from the time I conceptualized it, I was at a seminar, and I went home, started writing a little bit, then I put it on a shelf, and, so I wrote, an outline, which is where all books should start. The outline changes and you move things around, but I would, go through these little bursts of writing and then just get so tired of it. I would hate the project. I wouldn't pick it up for 3 months, 6 months. So it's not like I was writing the whole time. But during that time too, when I really, like they say about a condemned man, his mind is never more focused, because he knows the end is near. And when you have that book in mind, I start to see things on a chart, and I would, start capturing examples and, seeing, experimenting more and learning how to communicate it better as well before I actually put it into words.
Yeah. We live in a world where it's sad, but everybody has an ebook, everybody has a book, and the books are, I feel like every book being written nowadays is a lead magnet to get you to do something else. And there's something I find extremely satisfying about creating something. And especially when you create something, not for the end goal of trying to do something else, but just, this is what it is. And I'm sure you are, and you should be extremely proud about, just as I look through this from somebody who's created a lot of content in the past, this strikes me as just something that is well done. And I can appreciate the effort that put into this, and I imagined it took you years. So I was curious to...
Yeah, and it's self-published is why it looks so good, because I didn't allow some hack publishing company to put it all black and white into a little 4x6 format.
Interesting. Oh, very interesting.
Or 5x8 or whatever they do.
Yeah. It's something you talk about actually in the book, since we're on topic, is not confusing simplicity for being ineffective.
Yeah.
And could you I'm going to leave this, I'm going to kind of explain this in a roundabout way. It's going to be like an open topic, but if you could just give your thoughts on it, because I think that there's a dynamic in trading that is very prevalent where a lot of people are trying to keep it simple, but their simplicity is not effective. They are following something that does not give them an edge. There's no contextual placement there. It's almost not sophisticated enough to get the job done. And then there's people on the other side that are confusing the idea of more being better, and they are watching so many different things that they're making the process so much more difficult than it has to be. Can you talk about finding that balance and what that means to you as far as keeping it simple, but understanding that we are in this competitive, sophisticated space? So you are going to have, there is going to have to be some moving parts to what you're looking at.
Yeah, and I think I put that quote in the book, is that, the simplicity is the market's greatest disguise. The market is simple, but it's not easy. It's like, people often say it's like losing weight. Well, all you have to do is exercise more and eat less. Sounds easy, right? Well, but that beer tastes so good, and that whatever, I'm going to this dinner, I've got to make an exception for that. But at the end of the day, Corbs, what I always say, and I still say it to myself, is only price pays. That I can analyze a balance sheet, I can interview the CEO, and I will just believe that because I want to believe it now. I'm so invested in that opinion. Instead, it's all in the market. That's good information, especially if you're an investor and you need to, justify why you're going to hold this for 2, 3 years or whatever it is. You've got to believe in it. But for my time frame, I have the luxury of saying, you know what, the price doesn't agree, so I'm out. And it's about on my time frames, swing trading. It's truly about supply and demand for the stock. What influences that supply and demand? Warren Buffett, one of his quotes is, in the near term, it's a voting machine, and in the long term, it's a weighing machine. So we have the elections coming up, and people get all emotional and they bet on that. But now, how did that candidate do? We have to, weigh those 4 years that person was president. This 2 years. That's where we really start to understand. I'm all about tallying up the votes in real time and saying, here's who has control now. Wait a minute, looks like the Republicans are winning. Nope, now the Democrats got it back. Well, it's too messy in there. I'm not going to make the call. But once we start to see it surge in one direction, I'm going to latch onto that trend and be involved in that, as long as the data tells me the buyers are still in control. And as long as it's on that shorter term time frame, making those higher highs and higher lows, then I want to stick with it. So that's the simplicity for me. It can be different things for other people as well. One of the biggest things I talk about on Twitter, and has helped a lot of people, is if the stock or the market is below a declining 5-day moving average, just don't buy. Just wait. And as the semiconductors just dropped 12%, and there was no reason to buy the dip down 3%, 4, 5, 6, 8%, 12%. Now they're coming out of that. So just listen to the message of the market as objectively as you can.
Yeah. That simplicity of objectively listening to real-time market generated information. And it's one skill set to be able to get good at learning something or knowing a tool or knowing something. And it's almost a completely different skill set to be able to understand, what is that thing I need to master? What is that thing I need to listen to? And of course, there's no shortage of people online who are going to tell you, give you that, try to tell you that information of what you should be focusing on. Right. But on everybody's journey, that's something you've got to figure out and get clear about is, what does that simplicity look like to me? And thank you for explaining what it means to you.
Yeah, and it comes with, it's frustrating so how do I get there? And it really, unfortunately, comes from making all the mistakes yourself. You can read about the mistakes, but the only ones, for me, that I ever really learn are the ones I experience. And just muscle memory, doing the same things over and over again, and getting rid of the bad habits of trying to buy a stock while it's down and getting this perceived discount. It took me a long time to get over that, and some of my biggest losses came out of trying to buy dips and pullbacks. So I'm a reformed dip buyer, and it's been a long time since I've put that ugly hat on, and I've beaten that demon.
Let's talk about curve fitting, because something you talk about in the book is be careful on using this that way. And I think if you're coming out of, let's say, a method or kind of a worldview in the markets where you're basically just chasing around entries, everything that is about your method is just trying to show you entries, and you start to look at the market through value or the basics of an auction market theory, or you start to find these tools like the profile or VWAP, it can almost seem like this cheat code where you're seeing things differently. These levels are being respected very nicely. And if you're not careful, you kind of take this pure market generated information, beautiful piece of information that's context and can be used wisely. And you can start trying to use it as a, buy here, sell here sort of system, and lose context and then just start clicking the buttons away.
Right.
In your opinion, is there a time frame? I know you're pretty zoomed out, but is there a time frame that it's too small to be trying and like anchoring VWAP to every, pullback or something that's happening, and you're just going to get lost in the sauce? Or could it, sure, it could be effective scalping strategy. What are your thoughts on that?
I have seen it show me valuable, actionable information on 1-minute charts. That's not my preferred time frame. But if I know that, the market's a mess and we've got some volatility, I'm going to set my anchor from the beginning of the day. And let's say the market gaps down, it sells off till 9:53 a.m. Then it gets back above the VWAP for the day at 9:58. I might decide to buy as it's above that volume weighted average price, but then I'm going to set a VWAP to the low that occurred 8 minutes prior. And if it continues to ride that up, that gives me a reference point. So from the lowest value of the day, how are the buyers, handling this? How are the sellers handling this? So again, it's not my preferred time frame, but I really believe in the fractal nature of markets. I think that you could use a volume profile on a 1 minute time frame, and you could go do an anchored volume profile from 11:30 to 2:15 and probably find some value if that's your preferred time frame.
Interesting. Yeah. When you are, let's say you're using an intraday chart, and maybe it's something a little drilled in, like maybe not so drilled in like a 1 minute, let's say a 50-minute chart, or maybe a 1 minute, it doesn't matter. An intraday chart, let's say there's a VWAP being anchored from where that day begins. How many additional VWAP anchors would you say is just too many? Like you don't ever need more than one additional one, or there should not, you could 10 is fine. How many would you say is like too many on a chart?
So I will be aware, let's say we're looking at this S&P on a daily chart. I want to have one on the high that we made in July. But, the high that we made in July was 480 or something, and here we're at 420. It's just not relevant right now. So I don't have that on my chart. I'm aware I should have one there. If we start to rally up, I will look at that. Or from the August high. But we're so far away from it that it just becomes a distraction. So I want to keep the ones on there that are relevant, but also know that we had a significant high in August. We had a significant high in July. At some point when this market, if and when this market rallies back up, I want to be, looking at how it responds to those levels. So I try to keep it as simple as possible. So on my intraday chart right now, I have an anchor set on the Federal Reserve. I have one from the beginning of the week because I always have one on the beginning of the week. And I have one from yesterday's low. So I've got, 4 right. Oh, and one from the month to date, which is, it's still, it's 15 points above where we are. So that it's really not even relevant.
Yeah. Okay, great. I'm very careful about putting things on my chart because the curse of indicators is everything works some of the time. The market either goes up or it goes down. And it's easy to confuse the idea that this thing worked for me before as this is a useful piece of information that I can use moving forward consistently. And so I had to go through a process in my life of just kind of blanking out my charts and then slowly being very intentional about what else puts on there. And part of the filter I use is that if something's recommended to me or if something I think is helpful, I need to use it in a very intentional way. And I need to make sure that it's giving me a specific result. Even it doesn't have to be a P&L result, but this is helping me make a decision, or this is actually doing something. If not, it's got to go. With that in mind, if somebody's starting to use the anchored VWAP, you've mentioned a couple of things already. There's some obviously strategy in the book, a lot. And I think one of the powerful ways to use an anchored VWAP that I haven't been using, but I'm very interested to start using this forward, is anchoring it right to these big news events, non-farm payrolls, FOMCs, things that are reoccurring, and getting that very clear picture of who's in charge right now. And whenever there's a big news event, the news where that news event starts is always important to me, but I haven't been anchoring a VWAP there. Going on that and just using the idea of anchoring a VWAP at, let's say, those big news events, you talked about a couple other things about highs and lows, but if somebody was just completely new to anchored VWAP, starting to use it, maybe even before diving into like buying a book or something, where would you say is start anchoring it here and just, start observing it?
I mean, if you really want to learn it, the best way to do it is to see how relevant it is on a daily basis. And, start out with that, even if you're not going to trade the 1 minute chart, but have a 1 minute chart of the SPY or whatever your stock is, and just observe it from the beginning of the day. Don't set any from the highs and lows that day, and just start to see how prices are attracted to the VWAP. Whether it's, coming up from underneath and getting rejected at it, or pulling back down to it and magically finding buyers there for no other reason than that the VWAP is there. So start to just gain confidence that, hey, there's something happening here. and read the chat. Well, even if you don't buy the book, but understand this is the way that institutions commit large money to the market. They use program trades based around the VWAP and the anchored VWAP. That's direct out of, congressional testimony from Ken Griffin saying that, when they were talking about the GameStop, saying this is how we execute orders. That guy made $4.1 billion in 2022, more than any hedge fund manager has ever made in the history of hedge funds in 1 year. I think when he says something like that, it's worth listening to. Then add the second day VWAP and see how that works. See how, in an uptrend, we had a stock up 2% today. Next morning, it pulls back to, today's Thursday. Tomorrow morning, it pulls back on Friday to today's VWAP and then magically bounces for no other reason than that is there. Why is that? Start to look at it, understand the psychology of the market, that the market makers are trying to shake you out. They're trying to, they've got a big order to buy today. So they're going to short 50,000 shares in the pre-market to shake the stock down to see if they can get filled on 100,000 shares at those discounted prices, because they know they've got to fill the rest of the order throughout the day. And there's other competitive buyers in there. So understand the psychology of it, just like the psychology of a cup and handle or a Head and Shoulders. It's understanding the motivations of all the participants and then saying who are the biggest ones and what motivates them and where do they act.
Yeah, very well said. When you actually made a statement in the book that I'd love to hear you elaborate on, you said that fear knows no support and greed knows no resistance. Can you just elaborate on that idea and explain what that means to you?
Yeah, so again, lessons learned the hard way. I used to look at a stock and say, well, that stock's up 30% in 3 days. That's up too much. And I'm smart enough. I see this little 10-minute consolidation here on this 1 minute time frame. And as soon as it breaks that, I'm going to short it because it's up too much. And it'll pull back 25 basis points and then I'll go take a 5% loss. Same thing on the downside. People will say, well, it's at the 10-day moving average. I've got to buy some because it's down too much. So there's no such thing as down too much. When there's sellers, there's sellers. Respect the sellers are in control. Wait for them to finish up. Wait for sufficient demand to come in to offset that supply. You don't have to be the first one in there to make money. Let it balance out and then reconfirm the prior larger trend. So it's just a way of saying, don't short because it's up a lot and don't buy because it's down a lot. Those are some of the ways that I've lost the most money ever in the market is doing those two things.
Yeah, very powerful. It's a very powerful thought there. And it was good to hear your take on it and explain it.
Good.
The anchored VWAP.
Yes.
It's something that I think within an hour or so you can learn about. It's the volume weighted average price. Maybe, here's some intelligent places to anchor it. Here's some ideas of how to use it. And it is also something that you could use for 10 years of constantly growing and evolving and changing how you understand this tool and understanding how you are able to use it effectively and broaden the way that you're using it. And I think that when it comes to trading, it comes to anything maybe in life, it's very easy to confuse the fact that I learned something and then to shut down any growth you could have with that thing because you tell yourself, I know about it.
Right.
And the difference between learning something and really understanding it is that difference between I've been doing this for 10 minutes or I've been doing this for 10 years.
Right.
Could you explain a little bit? And you wrote an entire book on this one tool, basically, although there's actually quite a bit more in this book, but maybe just your thoughts on general of that idea of the danger of, I learned this and it's not, maybe not really working. So I learned something else and now everybody's a generalist. They learned a little bit about everything and they think they know it, but very few people just master something. Maybe just talk a little bit about what that journey looks like, what it really takes to master something, how long, you put into really learning something, just your thoughts.
I have a lot of ideas and concepts that are, unique and original about the anchored VWAP. And I don't feel like I know it all. In fact, I tried to make a point, I think, towards the end of the book saying, this is my start. You figure out other ways to use it. I don't use standard deviation bands. Some people love those. I think it's a great place to start and experiment and find out on your own. other ways to use the tool. It's a tool, and you can see with any. It's like a musical instrument. I mean, every note has been played, but have they all been played in that certain sequence? The three chords that comprise of 85% of all popular songs. They still work, and they're still finding unique ways for the practitioner, for the musician, to make them their own. And that's what I want people to do. This is the first of maybe several books about the anchored VWAP. Hopefully they're not all rehashes trying to just rip off a concept the way so many technical analysis books, just a repeat of something they've already read somewhere else. But I don't feel like I have it mastered. So I think it would be arrogant to think that we have any skill truly mastered. You look at the best athletes, they will say they will always, especially when you perform at a high level, you're your own worst critic, and you look at it and say, oh, I should have caught that pass. That was, I don't know how I got distracted there, or whatever you missed that note, whatever it is. Performance can always be enhanced, and we can always grow as humans. So maybe that was a little, is that you're kind of wondering there? Did I hit it?
It's funny because by not necessarily hitting it, you actually probably said the best thing you could have said about it. Because even as you're saying this, I was thinking about it. It's interesting that the most arrogant people are the people who know very little about subjects. And when people really dive deep on subjects to really understand something, they have this attitude that says, there's still so much I don't know. And it's a very powerful mindset to have about something, because when it comes to life, when it comes to making money, when it comes to trading, when it comes to VWAP, the worst thing that you can do is just shut down the learning process and fooling yourself into thinking you've learned it all. And it was a very humble answer, and I think a very telling answer of somebody who actually is on the path to mastery, because the deeper you go, the more you understand that there's a lot still to learn. And people that stay on the surface have much more of a different attitude. So that was
it takes you back to the question of how long does it take to write this? Well, part of it was also I needed to experience new things and play around with it. And I was going to put my name on this, and I wanted it to be great. And I could have sat on it for another 2 years and made it even better. But at some point you got to say, the baby's got to come out. It's due. And that's why, again, there's always something more to be learned and mastered and maybe written about. I don't think it's not my goal to do that, to expand further on it, but to give this as an introduction to other people to say, go expand on it yourself and figure out what works for you.
Yeah, very good, very good. And I'm gonna, as we're reaching the end of our time together, I'll give this a plug. And I have never had a product on this podcast I sit here and I talk about or anything. And I'll give you flowers one more time for it. And I encourage everybody listening to this that the book is called Anchored VWAP. There's a lot in here just about how markets move and understanding the market and understanding what your job is. And you'll have a lot of insights in here as a new trader. Even if you never, ever want to use anchored VWAP, you would still better understand how to trade and understand markets. And it's just great. And it's well done. It's well put together. It's very much worth the price. If you're listening to this, you should get a copy. I'm very glad that you put it together. I'm very thankful for your first book. And it was a pleasure getting to know you. I'm glad all those pieces connected in my life to bring us here. And I'm going to, I'll pause the recording and then we'll say goodbye proper, but we'll leave everybody here publicly. So if you'd like to say any closing words or anything on the way out, and then I'll say goodbye to you in just a moment.
Manage risk first and foremost. Find your time frame and your style, and always be curious and willing to learn more. But the market is what you make of it. So find your way.
Great way to end it right there.